In the shadowed halls of Tokyo's financial district, where the hum of trading floors echoes the pulse of global capital, a subtle yet seismic shift began to unfold in the final weeks of 2025. On December 15, reports from the Ministry of Finance confirmed what analysts had long anticipated. Japan, the world's largest foreign holder of United States Treasury securities, had initiated a series of sales totaling over $50 billion in a single month, marking the onset of what could become the most significant divestment in decades. This was not an abrupt fire sale, but the deliberate unwinding of positions accumulated over years, driven by domestic pressures and international currents. As yields on US Treasuries spiked in response, climbing to levels not seen since the early 2020s, whispers of a historic collapse rippled through Wall Street. Bond prices tumbled, borrowing costs for the American government edged upward, and investors worldwide braced for volatility. This event, rooted in the intricate dance between two economic giants, threatens to reshape the foundations of international finance. For Japan, it represents a strategic pivot toward self-reliance. For the United States, a challenge to the dollar's enduring dominance. As we delve into this unfolding narrative, we will explore the historical ties that bound these nations through debt, trace the methodical steps leading to this moment, uncover the lesser-seen forces at play, and consider the profound ripples it sends across the global economy. To understand the gravity of Japan's treasury sell-off, we must first grasp the fundamental mechanics of government bonds and their role in the world economy. Imagine the global financial system as a vast network of promises, where nations lend and borrow to sustain growth, manage deficits, and navigate crises. At the heart of this system lie US Treasury securities, essentially loans issued by the American government to fund its operations. These come in three main forms: short-term bills that mature in a year or less, medium-term notes spanning 2 to 10 years, and long-term bonds lasting up to 30 years. Investors buy them because they are considered among the safest assets available, backed by the full faith and credit of the United States, the world's largest economy. In return, holders receive periodic interest payments, known as coupons, and the principal amount upon maturity. The price of these securities moves inversely with yields. When demand is high, prices rise and yields fall, making borrowing cheaper for the US. Conversely, a sell-off drives prices down and yields up, increasing costs. Japan's involvement with US Treasuries dates back to the post-World War II era, intertwined with its remarkable economic ascent. In the 1950s and 1960s, Japan rebuilt from wartime devastation through export-led growth, channeling savings into manufacturing and technology. By the 1980s, it had become an economic powerhouse, amassing vast foreign exchange reserves from trade surpluses, primarily with the United States. To manage these reserves and earn stable returns, Japan's Ministry of Finance and private institutions invested heavily in US Treasuries. At the peak in 2014, Japan's holdings exceeded $1.3 trillion, making it the top foreign creditor to America, surpassing even China. This relationship was symbiotic. Japan found a secure haven for its savings, while the US benefited from low-cost financing for its deficits, which funded everything from infrastructure to military expenditures. The dynamics of this bond began to shift in the 2010s, influenced by Japan's domestic challenges. The country grappled with deflation, a persistent drop in prices that stifles growth, and an aging population that strained public finances. The Bank of Japan, or BOJ, responded with aggressive monetary easing, including quantitative easing where it bought vast quantities of Japanese government bonds, or JGBs, to inject liquidity and keep interest rates near zero. This policy, known as Abenomics after former Prime Minister Shinzo Abe, also weakened the yen, boosting exports but making foreign assets like US Treasuries more expensive to hold when converted back to yen. Meanwhile, the US Federal Reserve's rate hikes in the late 2010s created yield differentials, encouraging the yen carry trade, where investors borrow cheaply in yen and invest in higher-yielding US assets. Japanese institutions, including pension funds and insurers, poured funds into treasuries to chase returns. Entering the 2020s, cracks deepened. The COVID-19 pandemic disrupted global trade, and Russia's 2022 invasion of Ukraine spiked energy prices, hitting import-dependent Japan hard. Inflation, long dormant, surged, prompting the BOJ to gradually taper its easing. By 2023, it allowed JGB yields to rise modestly, signaling the end of ultra-loose policy. Concurrently, US rates climbed as the Fed combated inflation, narrowing the yield gap and making treasuries less attractive. Japan's holdings began a slow decline, dipping below $1.2 trillion by mid-2024. Yet, even as reductions occurred, Japan remained a net buyer in some months, balancing sales with purchases to stabilize markets. Geopolitical tensions added layers. The US China trade war, escalating through tariffs and technology restrictions, indirectly affected Japan as a key ally and trading partner to both. Fears of currency weaponization, exemplified by the freezing of Russian assets, prompted diversification. Japan increased gold reserves and euro denominated assets while exploring digital yen initiatives for cross border payments. By early 2025, holdings stabilized around $1.15 trillion, but whispers of a larger unwind grew amid yen volatility. The currency weakened to historic lows against the dollar, reaching 160 yen per dollar in April 2025, forcing interventions where Japan sold treasuries to buy yen and prop it up. As we approach the events of late 2025, the stage was set for acceleration. The BOJ's December 19 decision to hike rates by 25 basis points, the fourth such move in 18 months, marked a definitive pivot from negative interest rates. This tightened domestic liquidity, prompting institutions to repatriate funds. Concurrently, U.S. yields hovered around 4.5% for the 10-year note, reflecting Fed caution amid resilient growth. These factors converged, leading to the sell-off's initiation. Let us now break down the sequence of events in meticulous detail, drawing from official data and market reports. It began in October 2025 when Japan's holdings stood at $1.2 trillion, a slight increase from September's $1.189 trillion, according to US Treasury International Capital data. This uptick masked underlying pressures. Japanese insurers, facing higher domestic yields, began trimming foreign positions. By November, net sales reached $10 billion, as pension funds like the Government Pension Investment Fund, managing over $1.5 trillion, rebalanced portfolios toward JGBs. The catalyst arrived on December 1, when the yen plunged below 150 per dollar following U.S. economic data showing robust job growth, strengthening the dollar. The BOJ intervened, selling an estimated $20 billion in treasuries to fund yen purchases. This action, while stabilizing the currency, temporarily signaled vulnerability. Market participants took note. Hedge funds amplified bets against the yen, exacerbating the decline. On December 10, Japan's Ministry of Finance reported a $30 billion reduction in holdings for the month, the largest monthly drop since 2022. The sell-off gained momentum mid-month. On December 15, amid a BOJ policy meeting preview, Japanese banks unloaded short-term treasury bills to meet liquidity needs. Yields on the 2-year U.S. note spiked by 15 basis points in a day, reflecting supply pressure. By December 20, cumulative sales exceeded $50 billion, with long-term bonds targeted to lock in gains before potential Fed cuts. Satellite data from trading platforms like Bloomberg showed Japanese sellers dominating auctions, where demand for new issues waned. This phase revealed coordination. The BOJ quietly guided institutions through moral suasion, encouraging repatriation to support domestic bonds. As of December 23, 2025, preliminary estimates suggest holdings have fallen to $1.15 trillion, with further sales anticipated into year-end. Beneath these visible transactions lie hidden or less discussed factors that amplified the sell-off's impact. One is the yen carry trade unwind. For years, investors borrowed in low-yield yen to buy higher-yielding treasuries, profiting from the spread. As BOJ rates rose, borrowing costs increased, forcing liquidations. Estimates from the Bank for International Settlements pegged the carry trade at over $1 trillion globally, with Japan at its epicenter. The unwind, triggered by rate convergence, created a feedback loop. Treasury sales weakened bonds, raising U.S. yields and further pressuring the trade. Another underappreciated element is demographic strain. Japan's population, with over 30% aged 65 or older, relies on pension funds for retirement security. These funds, seeking stable returns, historically favored treasuries. However, domestic reforms in 2025, encouraging investment in Japanese assets through tax incentives, shifted allocations. The Government Pension Investment Fund, for instance, increased JGB exposure by 5%, necessitating foreign sales. Regulatory changes played a role. Basel III rules, fully implemented in 2025, required banks to hold more high-quality liquid assets. Japanese banks holding vast treasuries faced higher capital charges for foreign currency risks, prompting deductions. Less visible is shadow banking involvement. Non-bank lenders, less regulated, amplified sales through leveraged positions. Geopolitically, U.S. policies influenced dynamics. Trade tensions, including tariffs on Japanese autos, strained relations, reducing appetite for American debt. China's de-dollarization efforts through BRICS initiatives encouraged Japan to diversify subtly, avoiding over-reliance. Environmental and social factors subtly intersect. Japan's energy import dependence, heightened by nuclear phase-outs post-Fukushima, links to fiscal deficits funded partly by Treasury income. Sales could redirect funds to green transitions, but short-term volatility disrupts planning. The global implications of this sell-off extend far beyond bilateral relations, potentially heralding a historic reconfiguration of bond markets. For the US, higher yields mean elevated borrowing costs. Each 1% rise in rates adds roughly $350 billion to annual interest payments on its $35 trillion debt. This could constrain fiscal space, forcing cuts in defense or social programs, or tax hikes, polarizing politics. Markets face contagion. Treasury volatility spills to corporates, mortgage rates climb, cooling housing, stocks dip as borrowing stiffens. Emerging economies suffer. Dollar strength from rising yields crushes currencies, inflating import costs and debt burdens. Countries like Turkey or Argentina, dollar-indebted, risk defaults. For Japan, repatriation bolsters the yen, aiding importers but hurting exporters like Toyota. Domestic bond yields rise modestly, supporting savers but straining government finances with a 260% debt-to-GDP ratio. Broader shifts emerge. If Japan divests significantly, say, $200 billion in 2026, other holders like China, $689 billion, or the UK, $878 billion, might follow, accelerating de-dollarization. Gold prices surge as alternatives, while euro or yuan bonds gain traction. Supply chains feel indirect effects. Higher U.S. rates slow growth, reducing demand for Japanese goods. Humanitarian aid funded by stable bonds faces disruptions and crises. In reflecting on this pivotal moment, Japan's Treasury sell-off emerges as a confluence of necessity and strategy, not malice. It underscores finance's fragility. Bonds, symbols of trust, can unravel when incentives shift. For decades, mutual dependence stabilized relations. Now, divergence tests resilience. Yet opportunities arise. The U.S. might pursue fiscal discipline, reducing deficits to attract buyers. Japan could innovate, developing regional bonds or digital assets. Globally, multilateral forums like the IMF could foster diversified reserves, mitigating risks. History teaches bond market upheavals. From 1994's bond massacre to 2022's inflation spike, yield lessons in adaptation. As yields stabilize and policymakers negotiate, one enduring truth persists. In interconnected economies, no nation's debt is an island. Vigilance, dialogue, and innovation will determine if this sell-off heralds collapse or renewal. The bond market, ever the barometer of confidence, watches and waits. In the closing weeks of 2025, as global financial markets grappled with lingering uncertainties from shifting monetary policies and geopolitical tensions, a significant development emerged from Tokyo that sent ripples across the U.S. bond landscape. On December 19, following the Bank of Japan's decision to raise its policy rate to 0.75%, the highest level in 3 decades, Japanese institutional investors accelerated the repatriation of capital, resulting in notable sales of U.S. Treasury securities. Preliminary estimates from market data indicated net reductions in Japan's holdings approaching levels not seen in recent months, contributing to upward pressure on U.S. yields. The 10-year Treasury note yield climbed toward 4.17% by late December, reflecting increased supply amid subdued foreign demand. While not constituting a dramatic exodus, this incremental divestment highlighted vulnerabilities in the U.S. bond market, where foreign holders play a pivotal role in absorbing vast government issuance. Analysts observed that sustained trends into 2026 could challenge the market's absorptive capacity, potentially elevating borrowing costs at a time of elevated fiscal deficits. This episode, unfolding against a backdrop of policy normalization in Japan, underscores the interconnected nature of global finance and the delicate balance sustaining U.S. debt markets. To appreciate the context of Japan's Treasury divestment, it is essential to examine the mechanics of the U.S. bond market and the long-standing role of foreign investors within it. U.S. Treasury securities represent debt obligations issued by the federal government to finance budget deficits and refinance maturing obligations. These instruments bills for short terms. Notes for intermediate and bonds for longer maturities are auctioned regularly, with the Treasury Department relying on a broad buyer base to keep yields manageable. Yields, the effective interest rate paid to holders, move inversely to prices. Increased selling depresses prices and pushes yields higher, raising the cost of government borrowing. Foreign investors, including central banks and private institutions, hold approximately 1/3 of outstanding marketable treasuries, providing crucial demand that helps suppress yields relative to what domestic buyers alone might sustain. Japan's position as the largest foreign holder stems from decades of economic interdependence with the United States. Following World War II, Japan's export-oriented growth model generated persistent trade surpluses, accumulating dollar-denominated reserves. Investing these in US Treasuries offered safety and modest returns, while supporting the dollar's value benefited Japanese exporters by keeping import costs low. Holdings peaked above $1.3 trillion in the mid-2010s, declining gradually thereafter amid domestic policy shifts. By late 2025, Japan's portfolio stood around $1.06 to $1.1 trillion, still substantial but reflecting ongoing adjustments. The Bank of Japan's monetary framework has profoundly influenced these holdings. For years, ultra-accommodative policy, negative interest rates, and massive bond purchases depressed domestic yields, encouraging outflows into higher-yielding foreign assets. This fueled the yen carry trade, where investors borrowed cheaply in yen to purchase U.S. securities. However, persistent inflation and wage growth prompted normalization. Rate hikes began in 2024, continuing into 2025 with increases to 0.5% in January and further to 0.75% in December. These moves elevated Japanese government bond yields, narrowing differentials with U.S. counterparts and incentivizing repatriation. Broader economic pressures compounded this. Japan's aging demographics strained pension systems, prioritizing stable domestic returns. Fiscal incentives encouraged shifts toward Japanese assets, while regulatory frameworks under Basel Accords heightened costs for foreign currency exposures. The sequence of events in 2025 unfolded progressively, shaped by these converging factors. Early in the year, holdings fluctuated around $1.1 trillion, with occasional increases reflecting intervention needs to support the yen. Interventions involved selling treasuries to acquire yen, stabilizing the currency amid dollar strength. As the BOJ signaled further tightening, evident in speeches and outlook reports, institutional sellers emerged. Pension funds and insurers facing improved domestic opportunities trimmed positions. Data releases showed periodic net reductions, particularly in longer maturities. The December pivot crystallized the trend. The BOJ's rate hike on December 19, accompanied by forward guidance on potential additional adjustments, spurred accelerated flows. Market observations noted Japanese participation in auctions waning, with secondary market sales contributing to yield pressures. By December 23, cumulative adjustments for the month suggested meaningful repositioning, though exact figures awaited official tick reports. Less discussed elements amplified these dynamics. The carry trade unwind, while not systemic as in prior episodes, exerted steady pressure. Rising borrowing costs eroded profitability, prompting gradual closures. Hedging expenses for currency risk rose with yen volatility, further deterring holdings. Institutional mandates played a subtle role. Life insurers managing long-duration liabilities favored matching assets. Higher Japanese yields facilitated this domestically. Shadow flows through custodians sometimes masked true ownership shifts, complicating real-time assessments. Geopolitical considerations lingered indirectly. Alliance commitments ensured no overt weaponization, but diversification trends toward gold or regional assets reflected caution amid global uncertainties. The implications of Japan's repositioning resonate across economies. For the U.S. bond market, reduced foreign bid depth could elevate yields structurally, adding to interest burdens on a debt exceeding $35 trillion. Higher borrowing costs ripple to mortgages, corporate finance, and consumer spending, potentially tempering growth. Globally, yield convergence influences currency flows. Yen appreciation supports Japanese importers but challenges exporters. Emerging markets, sensitive to U.S. rate signals, face capital outflow risks if differentials widen elsewhere. Financial stability considerations arise. Concentrated foreign holdings introduce transmission channels for external shocks. Multilateral coordination through forums like the G7 may address absorptive challenges. In contemplating these developments toward the end of 2025, Japan's Treasury adjustments reflect pragmatic adaptation rather than rupture. Normalization in monetary policy, long overdue, realigns incentives without precipitating crisis. The U.S. market, resilient through deep liquidity, absorbs shifts, though vigilance on supply-demand balance remains warranted. This episode illuminates interdependence's evolution. Once anchoring stability, cross-border flows now navigate diverging paths. Opportunities for recalibration exist, fiscal prudence in the U.S., innovative domestic markets in Japan. Sustained dialogue fosters smooth transitions. Ultimately, bond markets mirror confidence in sovereign promises. As Japan repositions and yields adjust, the system endures through adaptation, reminding us that finance's foundations rest on trust, tempered by changing realities. Prudent stewardship ensures continuity, where shifts strengthen rather than undermine the global framework. In the final weeks of 2025, as global investors assess the implications of shifting monetary policies across major economies, a notable pattern of repositioning emerged in the holdings of United States Treasury securities by Japanese entities. Reports from the US Treasury Department, released in mid-December, indicated that Japan's aggregate holdings had declined modestly over recent months, contributing to subtle upward pressure on Treasury yields amid a broader environment of elevated government issuance. The 10-year US Treasury note yield hovered around 4.16 to 4.17% toward the end of December, reflecting a market adjusting to varied demand dynamics. This adjustment, driven primarily by the Bank of Japan's ongoing policy normalization, highlighted the sensitivity of the U.S. bond market to changes in foreign investor behavior. While not indicative of a precipitous exodus, the incremental sales underscored potential vulnerabilities in a system reliant on consistent overseas participation to finance substantial fiscal requirements. As we examine this development, we will review the long-standing interdependence between Japanese savings and U.S. debt markets, trace the progressive factors influencing recent adjustments, identify subtler elements shaping the trend, and consider the broader consequences for financial stability in an interconnected global landscape. To contextualize Japan's evolving approach to U.S. Treasuries, it is helpful to outline the core attributes of these securities and the historical role Japan has played in their absorption. U.S. Treasury securities constitute debt instruments issued by the federal government to cover budgetary shortfalls and refinance existing obligations. They span a range of maturities, from short-term bills to longer-term notes and bonds, and are prized for their liquidity and perceived safety, serving as a benchmark for risk-free rates worldwide. Foreign holdings, encompassing both official institutions and private investors, account for a significant portion of outstanding debt, helping to moderate yields by providing steady demand during auctions and in secondary markets. Japan has historically been the foremost foreign participant, with holdings reflecting accumulated trade surpluses and a preference for stable, dollar-denominated assets. This relationship deepened in the decades following Japan's post-war economic miracle. Export-driven growth generated substantial current account surpluses, leading to reserves invested abroad. U.S. Treasuries offered reliable yields and served as a hedge against domestic deflationary pressures. By the mid-2010s, Japan's holdings surpassed $1.3 trillion at times, underscoring a mutual reliance. Japan secured returns for its savings, while the U.S. accessed affordable financing. Domestic Japanese conditions have increasingly influenced this allocation. Prolonged low or negative interest rates, implemented to combat stagnation, encouraged capital outflows toward higher-yielding foreign bonds. Institutions such as life insurers and pension funds managing long-term liabilities sought duration and income abroad. The yen carry trade further amplified this, with borrowing and low-rate yen funding purchases of U.S. securities. Policy evolution began altering these incentives. The Bank of Japan initiated normalization in 2024, ending negative rates and gradually raising its benchmark. By December 2025, the policy rate reached 0.75%, a level not seen in 30 years following a series of measured increases. This shift elevated domestic yields, narrowing differentials with U.S. counterparts and prompting reconsideration of foreign exposures. The progression of adjustments in 2025 reflected these converging influences. Holdings fluctuated through the year, with periodic increases tied to currency interventions supporting the yen. However, as domestic rates rose and institutional preferences shifted, net reductions became more evident in monthly data. Reports for late 2025 showed holdings around $1.06 to $1.1 trillion, down from earlier peaks, with sales concentrated in periods of yen strength or portfolio rebalancing. The Bank of Japan's December rate decision accelerated this trend, as higher borrowing costs and improved domestic opportunities encouraged repatriation. Market participants noted reduced bidding at Treasury auctions from Japanese sources, alongside secondary market activity contributing to yield adjustments. Several underemphasized aspects contribute to the persistence of this repositioning. Rising domestic yields facilitate liability matching for insurers, reducing the need for foreign duration. Regulatory requirements for capital adequacy and currency risk management add incremental costs to overseas holdings. Demographic imperatives, supporting an aging population through reliable pension returns, favor home bias amid policy incentives. Carry trade dynamics, though moderated, continue to unwind gradually as rate gaps compress. Hedging practices, previously mitigating currency fluctuations, have become more expensive with yen volatility. Geopolitical stability in the US Japan alliance ensures adjustments remain market driven rather than adversarial, distinguishing them from other holders' motivations. The consequences of these shifts affect multiple layers of the financial system. For the US bond market, tempered foreign demand can exert upward pressure on yields, incrementally raising servicing costs on substantial debt. This transmits to broader borrowing rates, influencing housing, corporate investment, and consumer credit. Currency markets experience indirect effects. Yen appreciation from capital inflows aids import price stability but poses challenges for export competitiveness. Emerging economies monitor U.S. yield signals for capital flow implications. Institutional investors globally reassess allocations, potentially favoring diversified or regional alternatives. Fiscal policy considerations in the U.S. gain prominence, as sustained higher yields highlight the importance of demand sources. In surveying this landscape at the close of 2025, Japan's Treasury adjustments represent a measured response to domestic policy evolution rather than an abrupt withdrawal. The Bank of Japan's normalization, aimed at sustainable inflation and growth, realigns long-standing outflows without destabilizing markets. This process illuminates the adaptive nature of cross-border capital. Flows that once anchored low global rates now recalibrate amid changing incentives. Resilience in the U.S. market, supported by depth and diversity, accommodates such transitions. The episode reinforces the value of coordinated policies and open dialogue in managing interdependence. As yields settle and portfolios evolve, the system demonstrates capacity for equilibrium, where national priorities harmonize with collective stability. Prudent navigation ensures that repositioning enhances rather than erodes the foundations of global finance. In the final days of December 2025, as markets prepared for the year-end close amid a complex interplay of monetary policy adjustments and capital flow realignments, the pattern of Japanese participation in US Treasury securities continued to reflect the broader trajectory of policy normalization underway in Tokyo. Data releases and market observations pointed to ongoing, measured reductions in holdings by Japanese investors, both official and private, as the Bank of Japan maintained its path toward higher interest rates. The 10-year U.S. Treasury yield stabilized in a range around 4.15 to 4.2%, absorbing the incremental supply without dramatic dislocation, yet underscoring the market's sensitivity to shifts in foreign demand. This repositioning, characterized by prudence rather than urgency, illustrated the gradual recalibration of long-standing investment flows that have underpinned global fixed-income markets for decades. While far from a collapse, the trend highlighted structural considerations for a U.S. bond market tasked with financing substantial fiscal needs in an environment of evolving international preferences. As we examine this ongoing development, we will revisit the structural linkages between Japanese capital and U.S. debt instruments, detail the progressive influences shaping current adjustments, highlight underlying factors that sustain the momentum, and evaluate the enduring implications for financial equilibrium across borders. To place these adjustments in perspective, it is valuable to recap the essential characteristics of the U.S. Treasury market and the distinctive position Japan has occupied within it. Treasury securities serve as the cornerstone of global risk-free borrowing, issued in vast quantities to bridge annual budget deficits and roll over maturing debt. Their appeal lies in unparalleled liquidity, consistent auction processes, and the backing of the world's largest economy, making them a preferred asset for reserve management and portfolio diversification. Foreign investors collectively hold a meaningful share of outstanding debt, contributing demand that helps anchor yields lower than might otherwise prevail given domestic supply pressures alone. Japan, through a combination of official reserves and private institutional holdings, has long ranked as the leading foreign participant, a status derived from structural surpluses and a conservative approach to asset allocation. This prominence evolved over multiple decades. Japan's post-war economic model emphasized export competitiveness and high domestic savings rates, generating persistent current account surpluses that required investment outlets. U.S. Treasuries provided an ideal combination of safety, yield, and dollar exposure, aligning with the needs of exporters who benefited from a stable or stronger dollar. Institutional investors, life insurance companies, pension funds, and trust banks found in treasuries a reliable source of duration and income to match long-term liabilities, particularly during periods when domestic yields were suppressed by monetary policy. The Bank of Japan's prolonged accommodation, spanning negative interest rates and aggressive asset purchases, reinforced these outflows. By keeping Japanese government bond yields near zero or below, the policy framework incentivized the search for return abroad, sustaining substantial Treasury accumulations even as global rates fluctuated. The yen carry trade complemented this dynamic, enabling leveraged investment in higher-yielding assets funded by low-cost yen borrowing. Normalization efforts, initiated cautiously in recent years, have steadily altered these incentives. Incremental rate increases, culminating in the December 2025 adjustment to 0.75%, have lifted domestic yields, improving the relative attractiveness of Japanese assets. Forward guidance from the Bank of Japan has signaled continued gradualism, allowing markets and institutions to adapt without abrupt disruption. The progression of holdings adjustments throughout 2025 has been characterized by consistency rather than volatility. Monthly data revealed periodic net reductions, interspersed with temporary stabilizations linked to currency market interventions. As domestic opportunities improved, institutional rebalancing favored increased allocations to Japanese government bonds and other home market instruments. By late December, aggregate holdings were estimated in the vicinity of $1.06 to $1.09 trillion, reflecting a controlled downward trajectory aligned with policy objectives. Market mechanics facilitated this process smoothly. Secondary market sales, often executed through major custodians, provided liquidity without overwhelming auction dynamics. Primary participation at Treasury auctions remained present but moderated, allowing other buyers, domestic institutions, hedge funds, and emerging market reserves to fill gaps. Several subtler elements have supported the sustainability of this trend. Liability-driven investment strategies among Japanese insurers and pension managers prioritized duration matching. Rising domestic yields reduce the imperative for foreign exposure. Regulatory frameworks, emphasizing capital efficiency and risk weighting, introduce marginal costs for unhedged overseas holdings. Tax and governance incentives, introduced to encourage domestic investment, further tilt portfolio decisions. Currency hedging practices, while sophisticated, have faced higher costs amid yen volatility, diminishing the net advantage of foreign bonds. Demographic imperatives, an aging society reliant on stable retirement income, amplify the appeal of familiar yen-denominated assets offering improved returns. Broader diversification considerations play a quiet role. While US Treasuries retain benchmark status, incremental shifts toward gold, euro-denominated securities, or regional alternatives reflect prudent reserve management in an uncertain geopolitical climate. The ramifications of Japan's ongoing repositioning extend across interconnected financial domains. For the US Treasury market, moderated foreign demand contributes to a gradual upward drift in yields, adding incrementally to debt servicing expenses. These effects transmit to private borrowing rates, influencing housing affordability, corporate financing, and investment decisions. Fiscal planning gains heightened scrutiny, as sustained higher yields emphasize the importance of diverse buyer bases. Currency dynamics experience corresponding adjustments. Capital repatriation supports yen stability, easing import costs for energy and commodities while presenting challenges for export-oriented sectors. Global fixed-income markets observe benchmark signals, with spillover to sovereign yields in Europe and elsewhere. Emerging economies remain attentive to U.S. rate trajectories, as elevated yields can attract capital inflows or exacerbate outflow pressures depending on domestic conditions. Institutional investors worldwide assess duration and currency exposures in light of converging rate environments. Systemic resilience considerations arise periodically. Concentrated foreign holdings introduce transmission channels, though diversification among buyers mitigates acute risks. In assessing these developments as 2025 concludes, Japan's Treasury adjustments emerge as a disciplined response to evolving domestic imperatives rather than a disruptive withdrawal. The Bank of Japan's careful normalization fosters sustainable inflation and financial conditions without precipitating instability abroad. The U.S. market, underpinned by depth and institutional participation, accommodates repositioning through price discovery and adaptation. This episode reaffirms the fluid nature of capital flows in a mature global system. Patterns that endured for decades yield to new equilibria as incentives realign. Opportunities for enhancement present themselves, strengthened domestic markets in Japan, broadened investor bases in the U.S. Coordinated policy communication, and multilateral oversight support orderly transitions. Ultimately, the Treasury market's endurance lies in its capacity to reflect changing realities while preserving core functions. As Japanese investors recalibrate and yields find new levels, the framework demonstrates resilience, where measured change fortifies rather than undermines the architecture of international finance. Thoughtful stewardship ensures that interdependence evolves constructively, sustaining confidence across borders in an era of continual adaptation.